possible housing market crash in 2023 is worrisome for many Americans. With a market crash, also called a housing bubble burst, comes consequences like general economic downturn and instability. This makes it difficult for Americans to find their dream home. Economists are hesitant to call the current market a housing bubble. A housing bubble typically has the following characteristics. Home prices rise faster than income or inflation, low availability of affordable housing, high rates of subprime mortgages and predatory lending, high mortgage rates, low home inventory. In general, it's challenging to make the next housing crash prediction because the market can display many combinations of these features and not crash. When combined, these characteristics are generally a signal of poor market health. But economists have difficulty diagnosing a bubble until after it's already burst. Many of these characteristics reflect the market, but experts aren't calling it a housing bubble yet because the market doesn't reflect all the typical features. It will take some time to see how everything shakes out, but our research indicates that the housing market won't crash in 2023. Rising home prices typically, inventory follows the rule of supply versus demand. Pricing trends for homes are a bit more complicated as federal regulations and interventions can affect the housing market outlook. For example, federal regulations lowered mortgage rates at the onset of the COVID-19 pandemic to alleviate fears over a housing bubble. In theory, this should have made homes more affordable, but it had the following long-term effects: created high demand for homes when inventory was low, pushed home prices up because prices and demand continued to increase with such low inventory levels. The Federal Reserve then increased rates to cool the market. In April 2022, home prices were up 14% year over year. Key takeaway: rising home prices in 2022 aren't a reliable indicator of a 2023 housing bubble burst because pricing trends don't always follow basic economic rules. Low affordable housing inventory. The latest Housing Affordability Index report shows that affordability dropped by 21% between 2020 and 2021. This is the most significant year-over-year decrease since 2013. Additionally, affordability in 2021 was 20% less than it was in 2013. There's no shortage of competition in the affordable housing market. Everyone is looking for a good deal, including home flippers, which contributes to pricing out low-income Americans looking for a home. The number of homes for sale increases as home prices increase. Essentially, it's a buyer's market for the most expensive homes and a seller's market for the most affordable homes. Key takeaway: there's not enough affordable housing inventory in the United States to meet the demand. This causes more individuals to rent, often with higher monthly payments than mortgages. Subprime mortgages and predatory lending. Subprime mortgages and predatory lending refer to the unethical practice of lenders giving out loans to individuals who can't truly afford them. However, predatory lending is technically illegal, so it's difficult to determine if it's happening on a large enough scale to influence the housing market outlook. Key takeaway: mortgages are getting more challenging to qualify for. While this isn't encouraging if you need a loan to buy a home, it's a key reason why economists argue that we're not in a housing bubble. However, if this difficulty leads to increased instances of subprime mortgages, it could become a risk factor for a housing bubble. High mortgage rates. Mortgage rates are going up because of several economic factors. The Federal Reserve is the institution that sets national interest rates and helps regulate the value of the US dollar. As of August 2022, the Federal Reserve is raising its rates to help combat inflation. However, when Federal Reserve rates increase, mortgage rates do, too. Between March 2021 and 2022, 15-year fixed mortgage rates increased by 44%, and 30-year conventional mortgage rates increased by 48% between April 2021 and 2022. This is the most significant year-over-year jump for each, and it will be essential to see if rates decrease as the year continues. Both rates are still significantly lower than during the 2008 financial crisis. Key takeaway: mortgage rates are rising, which is one of the indicators of a housing bubble. However, economists think rising mortgage rates will bring down home prices by the end of 2022, reducing the risk of a market crash.